on Thursday, October 19th. We're looking at some positions here on my Schwab account. So let's take a look at Google. I don't own Google, but I do trade the options. So if you see here on this side, you see these expiration dates. So this is tomorrow, the 20th is these expiration dates. The Fridays, let me rephrase that. Google options, most options expire on Fridays. There's other options like the Qs and the SPYs, which are index ETFs. Those expire during the week, Monday through Friday. So anyway, you see these are almost worthless. They're worth, this one is not even a penny, it's half of a penny. So it's 96% down. These are only worth 2.5 cents. They're about 90% down. These expire tomorrow. If you see these numbers here, these are the number of options that I purchased, 24 and 22 respectively. Where you go down here, you see the negative sign. That means I sold those. I bought these, I lost on these. Well, I will lose on these, and I am losing on these. And these, I sold, and so far I'm winning on these. So these expire next Friday, a week from tomorrow. And if you see here in the green, obviously anything green is good. That means it's a gain. Anything red is a loss. Unless you're masochistic, you probably don't want this and you want this. Okay, so anyway, 15, 16%, about 20%. So you see these numbers here, 148C. The C stands for call option right here as well. A call option increases in value if the underlying stock, in this case being Google, goes up. Put options will go down in general when the underlying stock goes up, but they will increase in value when the underlying stock goes down. So you've probably heard people say you can make money whether the stock market goes up or down. That's true. Put options are used to either hedge positions, meaning protect your positions if it does go down, or if you're speculating and you just want to make money from market movement, then you can buy puts if you anticipate the market going down with that respective stock. So I hope that does make sense. Let's take a look here. Amazon. So Amazon, this is where it's trading at right now, 131 and 81 cents. It's up $3.68 at the moment. So you see these minus signs. That means I sold 5 each of these. They're 2 different line items because they're 2 different strike prices. These expire November 3rd. The 117 and 118. So what I'm looking for is I'm looking for Amazon to stay above these 2 levels. So it's at 131, 132 right now. So that's what $13 or so away from here. So between now and November 3rd, I have that time frame and I have some space cushion in order to see what happens. The current pricing is right here. So 96 cents per share means $96 because every option leverages 100 shares of stock. So if you have 5 options, you're leveraging 500 shares of stock. And you can see the math works out right here. $480 in value and $545 in value. These are negative because I sold these options. So to exit this position, I have to spend money. I'd have to pay $480 and I'd have to pay $545 if I want to exit. These numbers will change over time because these numbers will change over time. And these numbers will change over time because this changes. It could be every few seconds or minutes, whatever the case may be. The blue here, and it bears repeating. It never hurts to learn this and repeat this. So the blue is the amount, the premium, the dollars that I collected up front. That's my maximum profit. That's as much as I can make on this trade. Now, why would I do that? Well, the reason is the probability of winning is higher because most options expire worthless and unexercised. Someone could buy these options and they won't have that negative sign. It'll just be a 5 or 4, 3, 2, 1, whatever it is, but there will be no negative sign. They're looking for a bigger move. Maybe they can make 50, 100, 200, 300% on their money. The way I trade, I'm looking for a lower but more consistent return. So if someone goes to Vegas and they play blackjack or roulette and they make 1-to-1 on their money, that's fantastic. But the casino statistically will win in the long run. So I'm taking the side of the casino in this strategy. I'm not making huge returns, but it's like baseball. Instead of going for home runs or grand slams, I'm just looking to get a single over and over and over again. So that's how I do it. I like the consistency. All right. So anyway, we have time. We'll revisit these because we still have a few weeks left before these do expire. This here, red, if you bought the option, that would not be good for you. But because I sold the option, they are good for me. I know it's backwards. It's literally backwards. So if you see it's down 36, just over 36 cents, you multiply that by 100 and you multiply that by 5, you'll end up seeing this number. So my position actually improved my account balance by $182.90. Look at this one. This one as well, because they're almost identical, just a different strike. Same number of positions, same expiration, just a different strike price. Anyway, this one is also in my favor, even though it's red. So whoever's buying these options or has purchased these options, they're down by this much. So I hope that does make sense. I know I've probably skipped over a lot of steps and foundational information, but I will have information with slide decks and things so that it's a better visual. So that's what I'm still working on. I'm using loom.com. I just was told about it by a friend of mine so that I don't have to hold my iPhone camera to my screen and start shaking. Now at least I have a steady screen to look at. So hopefully this helps you. And thank you for watching. And I'll put up another video soon. Have a wonderful day.